Good afternoon. This is Victor Orozco, Managing Partner and Director of Operations for Bear Financial Planning. We wanted to reach out to you this week in regard to the turbulent moves we've had in the investment markets. During these times, you start hearing all the buzz phrases. You should have a long-term perspective. A correction of 10% or more is perfectly normal. And although we do agree with those, today's video is not about that. Although the S&P 500 has hit a historic high and experienced a 10% correction within 9 days. That's never happened before, and it's quite a historic event, and there's no way we could discount that. However, being normal and how that applies to you is something we want to talk about today. Having the proper expectations around your portfolio is huge. When we construct a portfolio for our clients, we like to statistically show how it can operate in good times and equally as important, the negative times, to match their risk level, or as we like to say, your sleep factor. For example, if you were to hold 60% of the S&P 500 and the other 40 would be in the Barclays Bond Aggregate Index at the other 40%, you can experience a swing of -9% to +16 in a 6-month period. And that would be normal given the mix of investments you have there. Now, if that doesn't feel good to you, then that may not be normal, and that'd be something to consider when it comes to your portfolio mix. And did Victor just say 6-month period? And I said yes, 6 months. Now, although we do have the long-term approach, and we get that, and you hear that all the time, it's the short-term behaviors that are our fight and flight DNA that may have us sell too soon and not experience a full cycle when it comes to the markets or our investments. So we really want to make sure that you have the expectations around your portfolio and what it can and can't do. Think of it as getting in line at Disneyland, expecting a very calm, peaceful ride, and ending up on Splash Mountain. And by then it's too late, and you thought you were expecting one experience, and in fact you got the other. So that's very important to realize and look at the risk of your portfolio to figure out what you do own and how it could look. So to land the plane for today's discussion, number one, determine the negative to positive range your mix of investments has historically done. Number two, based on the goal of your investment, ask yourself if that is a comfortable range for you. Again, not what is normal for an index, but rather your personal index. And if you don't know where to start and you think action is needed, we're here to help. You have a link above that you can click that schedules a time to talk with myself or even with Marcy, and we'd be happy to help and see what's on your mind.